Good day, ladies and gentlemen, and welcome to the Whittier Trust Actionable Ideas conference call. At this time, all participants are in a listen-only mode. If you would like to ask a question at any time, please type in the lower left-hand side of the screen. The presenters will answer them after the end of the presentation. I would now like to turn the call over to David Dahl, Whittier Trust President and CEO. You may begin.
Good afternoon, and thank you for joining us for Whittier's webinar on actionable ideas. Today's theme is long-term investment implications. What changes and what will endure? Several weeks ago, we began distance learning through webinars. At our first webinar, we focused on our outlook for the economy and financial markets. We followed that webinar with one on opportunities to transfer wealth to your children, grandchildren, and intergenerationally. We discussed opportunities in real estate and how Whittier is one of the few trust companies that actively purchases, manages, and 1031 exchanges real estate as a strategic asset class. And last week, Tom Frank spoke on the importance of choosing the right trustee. At Whittier, we have a clear mission, and that is to take care of our clients and employees. I'm extremely proud of our team. We have been in constant contact with our clients, and in this volatile period, we have preserved wealth. Whittier's multifamily office and holistic approach to wealth management brings stability, reliability, and confidence to our clients. Within 19 days, we went from a peak in the stock market to a 35% decline, one of the fastest declines in history, and we have bounced back over 30%. As we look forward to a changed and changing world, we see new paradigms and themes that complement traditional investment models. To walk us through all of this is Caleb Silsby, Chief Portfolio Manager at Whittier Trust. At the end of his comments, Caleb will take questions. Thank you for attending Whittier's webinar on actionable ideas. Caleb?
Thank you, David. Good afternoon. Thank you for joining us for a webinar about the long-term investment implications of the coronavirus policy response and the social response. Today, we're going to have fun. There's a lot going on in the world that's not so fun. So today, we're going to take a long-term perspective. And the first concept we'll talk about is that even in a virtual world, the DeLorean is the best mode of time travel. So we're starting today's approach with the assertion that we're actually in 2021. And in 2021, there's a vaccine available, test kits are widely accessible, herd immunity is in place, and we're living in a familiar but an adjusted or different normal. So take a deep breath and imagine a world where you can hug your grandparents and hug your grandkids. As long-term investors, we recognize there will be significant changes to the real economy and the investment world after coronavirus. Perhaps we're living in this new world where flights are $25, traffic in Los Angeles doesn't exist, and dolphins are swimming in the Venice Canal. But more likely, the overcrowding that we've seen on the beaches in Florida and in Southern California over the past few weeks are a better indication that while some people are adapting and changing, people are fundamentally social animals. They crave adventure, they crave experiences and time with friends, and ultimately they need to work to pay the rent and put food on the table. Thus, our experience through multiple market cycles tells us that some behaviors and some important long-term investing tenets will endure. We're actually going to spend a lot of the talk this afternoon talking about trends that are already in place and are accelerating at a more rapid pace as a result of the global response to the coronavirus. We'll talk about 6 themes, 2 that are accelerating, namely e-commerce, which you see on a daily basis. The second accelerating theme we'll talk about is ad spend and how that will follow time spend. We'll talk about 2 themes that are changing, personal space versus experiences that people wanted to engage in, and also how companies are going to respond from a control perspective. And finally, we'll talk about 2 themes that are going to endure, monetary policy and the outsized impact that will have on the market, and debt levels across the economy. And then finally, the approach to investing in this world. The first theme is that e-commerce is going to accelerate. You know that e-commerce has grown substantially over the last 20 years, from less than 1% of retail sales to greater than 10%, tenfold increase. And just imagine living through this crisis without the fulfillment centers and without the infrastructure in place, the distribution network that we have in place. The lines that you see at Costco and other grocery stores would be far, far longer. So this great leap that we're seeing in e-commerce is an acceleration of an existing trend. Imagine 2025, what we would see in 2025 in terms of e-commerce will happen in 2021 because it's accelerating at such a rapid pace. Right now, not only are consumers being trained, but companies are learning as well. This slide shows that if you look at all e-commerce, it's up about 40% year over year. That's the blue line. The orange line shows that particularly within grocery, at one point up 250% year over year. Consumers are learning, they're downloading the app or they're logging into the website and they're inputting their grocery list. One of the hardest or the biggest impediments to shifting towards grocery through e-commerce was retraining the consumer. The consumer was so used to getting in the car, driving down the street to the grocery store, and then buying their products at the grocery store. Now consumers are being retrained at an incredible pace. And as they upload their grocery list, the grocer then learns a lot more about the consumer. In this case, just to take Amazon, for example, Whole Foods, if you log into the Whole Foods app, Amazon now knows the cadence with which you buy a toothbrush, milk, eggs, etc. They're able to pre-populate your grocery cart, send you specials or deals in a timely basis. So the entire experience, both from the consumer's perspective and the learning that's occurred at the grocer's perspective, is making online grocery shopping that much better. E-commerce is going to accelerate at a rapid pace through this, not just because of demand, but because the learning that will occur at both the consumer and the business level. As we're spending more time online, the second theme is that advertisers will spend more of their dollars online as well. This chart shows visually how the advertisers tend to spend their money as people spend their time. And in the beginning, you can look on the chart on the left, the time spent was declining in terms of traditional print media. Advertisers were slow to react, but ultimately the ad spend fell in line with the time spent. The chart on the right-hand side, this is the time spent on desktop and mobile, so online. And as time spent crept up, ad spend met that time spent there. This will continue. Obviously, we're spending more time online, and advertisers are going to shift in that direction as well. One big impediment to cutting the cord, for example, was a lot of people had cable TV because of live sports. Well, we're having a multi-month pause in live sports, so people are cutting the cord much faster, shifting to video on demand and S-video on demand, subscription video on demand. So through Hulu and other channels like that. One major theme that's changing here is as people spend more time online and in their own home, they care more about their personal space. And this is a shift in a very, very long-term theme where consumers had been exhibiting a preference for experiences over things. So millennials would be the key cohort here, where millennials tended to go out to dinner and pay $15 for a glass of wine. They were part of the sharing economy, doing more Airbnbs and traveling to exotic vacations. You can see in this chart, this goes back 60 years, but the amount that people were spending on things as a percentage of their income has gone down dramatically, and the amount that they were spending on experiences has increased dramatically. This may be shifting, and some portion of this will shift as consumers place a greater emphasis on their personal space. You can see this chart is an incredible chart, shows home ownership rate, and you can see there's a trend from the depths of the housing and real estate recession in the early 90s, where home ownership rate went up to nearly 69%. And then we saw, after the financial crisis, an incredible decline in the home ownership rate as millennials chose to shift towards renting versus owning. We're starting to see this trend reverse, and coronavirus and the policy response to coronavirus is accelerating this reversal, where people are going to care more about their personal space, and where they have the ability to own, they will certainly have the willingness, because they're going to care more about setting up a home office, setting up their own garden, et cetera. And demographics plays right into this. So the chart on the left-hand side, you can see home ownership rates by age group. If you're under 35, the ownership rate is around 36%. Between 35 and 44, you see a huge jump up to 63%. And you can see that the largest percentage of the population is about to enter the prime home buying age. So demographics favors that trend as well. As consumers are going to change their preferences, businesses will change theirs as well. If you're a CFO or a CEO, you care about control right now. You feel like there's a number of things that are outside of your control. So reshoring is the first component of the control premium theme that we're going to talk about. Boeing, unfortunately, is going to be the poster child here, where Boeing is really the business school case study for over outsourcing. The Boeing 737, the classic, when it first came out, only 10% of the products were outsourced, or the supply chain was outsourced. By the time Boeing came out with the 787 Dreamliner, 80% of the components were outsourced. And when we know the Dreamliner was 3 years delayed and billions of dollars in cost overruns, the fuselage alone was made in South Carolina, Italy, Japan, and Kansas. And that's just the main body of the airplane. Imagine where all the component parts were manufactured. And it's clear that living through this virus, one small disruption can lead to very widespread and very expensive long-term disruptions. So contrast that with SpaceX. SpaceX, 70% of the rockets are manufactured in-house. They have a shortened and more vertical and integrated supply chain, and they want control over the entire manufacturing process. As companies have a choice between capital and labor, they're going to spend more on capital, because after this crisis, it's more expensive to have labor. And part of this theme is that reshoring will take place. Not only do companies want control over the manufacturing process, they also want control over the distribution process. So here we see a slide on Nike. Nike, for several years now, has been growing their wholesale business at around 5%. They've been growing their direct-to-consumer by double digits. So Nike placing a greater emphasis and a control premium on selling directly to the consumer. We talk about this in terms of an omni-channel distribution, where they have control over the distribution through multiple channels, and they can control pricing to make sure pricing is consistent. They also can learn a lot about the consumer, which ties back into our earlier theme about targeted advertising through online ad spend. So not only will companies want to control the distribution of physical goods, they'll also want to be able to control the distribution of information. You can see Microsoft, they have the Azure Stack instance and then the Azure Cloud. So a combination, a hybrid cloud offering where they do both on-premise IT and off-prem in the cloud, allowing companies to have specific workflows that are still on-prem, and so they have control and they have different security there. But those companies over time may shift some processes to the cloud. And Microsoft, because of this omni-channel distribution of information, is able to sit in a place where they can capture not only the current workflow, but also the transition of future workflows. So companies are going to want control over the manufacturing process, over the distribution. They're also going to want control over their employees. If more employees are working from remote locations, how do you control that? And also, as we move to more and more software applications, how do you make sure they're integrated? A company like ServiceNow with the Now platform, you can see it's very spreads widely across a lot of different business functions, everything from security to HR to customer service to IT. But what they do is they're automating paper-intensive processes. So you're able to seamlessly update applications and seamlessly integrate applications, even when people are working in remote locations. This gives companies control over the remote work environment. It's amazing. You may not have heard of ServiceNow, but their average contract is more than $1 million in recurring revenue annually. So they're growing. They're expected to grow their revenue by 28% this year, even in the face of coronavirus. So this all sounds good and is uplifting, but how are we going to pay for it? Well, the fifth theme is that monetary policy will enable rather than cure high debt levels. We've heard about the CARES Act and the federal government committing upwards of $3 trillion now in terms of stimulus, which the government will have to borrow to take on that stimulus. So the Federal Reserve is coming in from the other side and is buying up a lot of Treasury debt to make it so that the deficit and the debt is feasible. Here we can see on this chart, in the financial crisis, quantitative easing one was a little bit more than $1 trillion. The Fed then engaged in quantitative easing 2 and QE3. We got to the point where the balance sheet was above $4 trillion, and then the Fed tried to do quantitative tightening, which didn't work, so they reversed a portion of that. And then you can see the policy response has already been north of $2.5 trillion, and expectations are for that to be upwards of $5 trillion by the end of the year. So the Federal Reserve's balance sheet, while it went up by $1 trillion in the financial crisis, could go up by $4 or $5 trillion in the COVID-19 crisis, the Great Lockdown. So incredible response by the Federal Reserve. By taking on significantly more debt at the federal government level, we've maintained a fairly strong currency despite that. And so you may ask yourself, how is this possible? How can the Federal Reserve go out and buy debt from the federal government, and when the federal government pays the interest payment on Treasury bonds, it goes to the Federal Reserve, gets taxed at 100%, goes back to the federal government, and essentially wipes out any interest payment due. And so how is this possible? Well, it's possible largely because we're the reserve currency of the world. The U.S. dollar is the reserve currency of the world. If you look around the world, think about the regulatory capital that banks have to hold, the amount of Tier 1 capital. Most of that Tier 1 capital, actually 60% of that Tier 1 capital, is held in U.S. Treasuries. And at the same time, a number of foreign countries around the world hold U.S. dollars for their reserves to prop up their own currency. So as long as we are the reserve currency of the world and bank regulators around the world require banks to hold U.S. Treasury bonds as a risk-free asset, we will be able to get away with this. And to give you an example from a more colloquial perspective, imagine you're giving your son or daughter a loan, and your son or daughter is having trouble paying back the loan. So you have the option of raising the interest rate to incentivize them to pay it off sooner, or lower the interest rate to make it easier for them to pay you back. In this case, the Federal Reserve has lowered the interest rate to make it easier for the federal government to pay them back. You can also think about, at some point, do you forgive a portion of that loan? because they're not paying it back. And that's what the Federal Reserve is doing here, while the Federal Reserve is going out and buying Treasury bonds and allowing the federal government to continue to refinance those bonds within the Federal Reserve. They're essentially forgiving a portion of that note. So the fifth theme is that monetary policy, while it may be intended to help ease the burden of federal debt and deficits, it's actually enabling federal debt and deficits. And so this chart here shows the federal net debt as a percent of GDP. And you can see that we're approaching where we were in World War II, and we will actually exceed that over the next decade. And so we've told you that despite this, you're still going to see pretty low interest rates, and the Federal Reserve is enabling this. So the question then is, what do you do in this environment? How do you invest? Well, the sixth theme that endures here is that high-quality companies and productive real estate are going to continue to be nearly unmatched on an after-tax basis. This chart here shows the total return by credit quality, and it's like stair steps from AAA to AA to single A. You can see the returns or the losses are far less at the higher quality levels. So quality matters. It matters what you invest in. It's not just in the discussion of, I think, there are concerns in the global economic level, should we invest or not invest? It's just as important to think about the quality that you're investing in. And if you take a very long-term perspective, time is on your side. Over the past 30 years, the S&P 500 index return, total return, including dividends, assuming you paid no taxes on those dividends, you reinvested the dividends, over 1,500%. And in that time, we've had the Asian financial crisis in the late 90s, where long-term capital management blew up, and Russia defaulted, and Mexico defaulted. We had the dot-com bust. We had the financial crisis of 2008 and 2009. We had a European sovereign debt crisis. And now we have the COVID-19, the great lockdown, and we're dealing with this crisis. Yet it's still a pretty favorable game. And if you take a very long-term perspective and own high-quality companies, the investment returns, we think, over the next 30 years, maybe not quite as good as this, but there's a fair bit of margin for pretty good returns to follow. So as a summary, we talked about two themes that are accelerating. We talked about how e-commerce, a theme that has been prevalent and you see it every day, but not only is it accelerating because of demand, it's also accelerating because the learning that the consumer is doing and that the business is being trained on, it's making the experience that much better. And there will be huge increased demand for fulfillment centers and an increased distribution network. Some people had doubted whether grocery would shift to online. This is forcing a big shift there. We talked about how advertisers are going to spend their money where people spend their time. So ad spend will follow time spend. And there's an old saying that I know that 50% of my advertising dollars are wasted. I just don't know which half. And the beauty with online advertising is that it can be very targeted and it can be measured, and results can come back to you. So businesses prefer to advertise in that way. Now that consumers are spending a great portion of their time in that direction, you'll see advertisers continue to move there. We talked about two themes that were changing. Consumers for a very long time have preferred experiences over things, and that's reversing. People are going to care about the things around them. So home gyms as opposed to going out to gyms. People have made big investments in home gyms through this crisis, and on the backside of this, they're going to want to see that investment play out, so they may not be going out to other gyms as much. And the personal space is going to really push on people to own homes as opposed to renting. So there's going to be a larger willingness and maybe a lower ability, but there's going to be a larger willingness to buy versus rent. And this has big implications for companies like Lowe's and home improvement stores. Companies are going to want more control. They want control over the supply chain, so everything that the manufacturing process. They want control over how they're distributing both physical goods and information, and they're going to want control over their workforce, especially now in a remote work environment. And then we talked about two themes that will endure. Central banks are going to be with us for a long period of time and manipulating and significantly supporting over-indebted sovereign nations. And central banks are going to enable high debt levels. And finally, we talked about what to do in this environment, how to invest. And quality companies and direct real estate have been some of the best investments over the last 30 plus years, and we think over the next 30 plus years that will endure. High quality companies and direct real estate will be nearly unmatched on an after-tax basis for long-term investors. So thank you for listening in, and thank you for your time, and I'll open it up to questions.
Thank you, Caleb, for sharing your presentation, what changes, what endures with us. It's always great to listen to you and the Whittier Trust team and have the opportunity to learn. For those of you who have been listening live, please continue to send your questions in through the webinar platform. Thank you to those of you who have already submitted your questions. We're going to spend the next few minutes answering some of those questions. Caleb, the first question that multiple participants have asked us is, what do you think about reshoring the biomed sector, specifically as it relates to national security?
Yeah, it's a great topic, great question. There are concerns both from a sovereign perspective and also from an ethical perspective, depending on which company comes out with the vaccine first and they're distributing it. Are they going to distribute it to the people within their own borders first, or will they distribute it globally on a pro rata basis? So there will be, going forward, a number of studies about this, and it will be very political. So just as we talked about the reshoring effect that will happen in the industrial economy, this will also happen in the biomed sector. And if you look at right now, the pharmaceuticals being produced around the world, roughly 3/4 are produced outside of the U.S. And of that, the ingredients, the largest producers are in India and in China. China obviously being relevant from a political perspective at the moment. So yeah, I would say that the reshoring theme applies broadly. It applies not just to traditional manufacturing businesses, but also to healthcare and the pharmaceutical industry as well. So there, a couple of years ago, we were talking about inversions, where companies were trying to leave the United States because they could seek lower taxes in other countries. And so they were following the economic incentive. In this case, we're going to need to either provide the economic incentive, or we're going to need to subsidize companies to produce those drugs in the United States. So either way, it comes back to economics and then policy to support that. But to answer the question, I would say it's absolutely going to be a hot topic for a number of years to come.
Okay, thank you. The next question that we have relates to Amazon, and you mentioned a possible shift in sort of purchasing habits online. Currently, though, how much growth in e-commerce is due to Amazon?
Amazon has been a huge chunk of the growth in e-commerce. Actually, surprisingly, over the last year or so, some other companies have been growing faster in e-commerce than Amazon, but that's just largely due to the size of Amazon. But if you think about what Walmart and Target and others have done in terms of shifting into e-commerce, they at first resisted it a little bit, and now they are diving in head first. So at one point, Amazon was 50% of all e-commerce, and it's declined. It's now roughly 40% of e-commerce. But the initial growth of e-commerce was huge. So when people talk about e-commerce and Amazon as synonymous, it's actually it's fair, right? So because it is Amazon is by far the largest e-commerce player and has had a significant impact on the growth of, as I said, the distribution network, which has made this possible.
Okay, thank you. The next question revolves around the reserve currencies. So there have been a lot of other reserve currencies in the past, and they have failed. What keeps the US dollar as the reserve currency?
Yeah, it's a good question. The chart that we had measured centuries. So yes, there are a number of reserve currencies, but they do tend to be measured in centuries rather than years or decades. So they do last for a long period of time, and it is difficult to disrupt an existing reserve currency. That certainly could happen at some point. Right now, there's no immediate threat. The closest would be the Japanese yen, but Japan has more debt than we do, and they have higher debt to GDP than the U.S. does. They also have engaged in quantitative easing at a much higher level than the U.S. has, and even their stimulus response to the coronavirus has been larger as a percent of GDP than the U.S. So not a big competitive threat there. You could talk about the euro. The euro has monetary union without fiscal union, which is a big problem. You have individual countries that have set their own fiscal policy, and they've tried to pull that together, but there's still the debate around whether the euro breaks up at some point or if it stays together. So unclear that the euro as a currency has won, is better than separate currencies. And for that reason, people are going to be cautious about engaging the euro as the reserve currency of the world. So you kind of get back to the cleanest dirty shirt argument, where yes, the U.S. has engaged in economic policy and fiscal policy, monetary policy that is pushing the limits that the reserve currency of the world should engage in, but it's happening around the world. You're seeing quantitative easing and not just the yen and the dollar and the euro, but you're seeing it in much smaller, even emerging nations at this point. So I'd say there's a couple things that keep the U.S. dollar as the reserve currency of the world. One is that there's no other alternative, right? We are the cleanest dirty shirt. The second is that it's very difficult to disrupt a reserve currency. You have, not only do you have other countries that have invested in those reserves, but you have, as I said, the banking system that depends on it. So at some point it will be threatened. In the next 5-10 years, we think the U.S. dollar as the reserve currency endures.
Okay, thank you. That might be my new favorite saying, the cleanest dirty shirt. A follow-on from that answer is inflation, deflation. What can be expected short and long term?
Yeah, great question. We're getting asked that a lot from our clients. Very, very difficult to maintain price stability when you're going from 3.5% unemployment to 20% unemployment, and hopefully swinging back to single-digit unemployment. So that would, absent the Federal Reserve's engagement here, this would be very, very deflationary. If company borrowing costs were going up and you saw more bankruptcies and more people losing permanent jobs, not just temporary jobs, but permanent jobs, and the government taking on debt with a promise to repay that debt through higher taxes or less spending at the government level, that would be very, very, very deflationary. And so we're not seeing that, right? The Federal Reserve has come out and been so aggressive in terms of propping up asset prices, making sure that bonds are trading at levels where interest rates are still extremely low for most companies. And so now you worry about, inflation being a problem. So I would say primary concern with deflation, the Fed has been very aggressive to stave off concerns of deflation. So the concern around inflation, At Whittier, we think you need reflation before you see inflation, right? So inflation comes from excess demand for a certain number of products and services. And right now, you're not seeing that excess demand. I would also say that after the financial crisis, a lot of people were worried about inflation and runaway inflation from quantitative easing, and it didn't happen. You saw asset price inflation where the Fed lowered interest rates and through quantitative easing pushed up asset prices, but it did not flow through to price changes for the broader economy. So until we get back to fairly low unemployment rates, we think it's unlikely to see significant inflation here. We think the more likely scenario is that you see reflation before you see inflation.
Okay, we have time for one final question. In general, what other trends are you seeing?
Yeah, so there are a number of other trends that we are talking about internally within the investment department. I guess as I look out my window right now, I see that Starbucks has just opened. And so I'll use that as an example for a broader theme. There's a number of small businesses, mom and pop operators that have small retail coffee stores. You probably know of a couple in your local town. It's going to be very, very difficult for them to survive this. And you probably don't have any friends that are thinking, I want to go and start a small coffee shop right now, because not only do you take on the risk of operating that business, but then you also take on the risk of having to pay rent and employee wages with no income for several months. So the larger, more dominant players are actually going to come out stronger on the backside of this, because some of the small, fragmented, weaker players are going to be disrupted and displaced. The smaller, the emerging players who have, let's say, 14 or 15 locations and can now gain market share from the small mom and pop operators, some of those will emerge winners as well. So I would say it's going to be the dominant players. Those that survive will come out even stronger. The smaller niche players will be able to gain market share, and all of that will come at the expense of the one-off owners that are trying to compete against that space. So look, several other themes here. Telemedicine is a big one that we're very excited that telemedicine is improving, and hopefully that can bring down costs of healthcare. Food delivery has seen a huge shift in that direction, and then we'll see in terms of will the school system change over time? Will you see more online education at least higher ed levels? So there's a number of themes out there. Hopefully we highlighted some interesting themes that are accelerating and changing and enduring. So if there are no further questions, I thank everyone for spending some time with us today. Again, focusing on the positives, because there's enough negative news out there, and we think that over the long run, it's encouraging to see that something that, an approach to investing that has worked so well over such a long period of time, we think will endure and will work over the next 20 or 30 years. So excited to share that with our clients as well. So I'll leave it there. But thank you all for attending.